Sarah builds a carefully selected dividend portfolio. Ryan puts everything into a single total market index fund. Same monthly contribution, same 30-year timeline. Sarah watches dividend payments roll into her account every quarter and feels like she's already living the dream. Ryan watches a number climb on a screen and wonders if he's doing something wrong. Sarah thinks she's playing the smarter game, and honestly, for the first few years, it looks that way. But the gap between what she believes her dividend income is generating and what it's actually costing her, in taxes, in stunted growth, in compounding she'll never recover, will fundamentally change how you look at dividend investing. When you run the honest numbers, one strategy wins by a margin that isn't even a close call, and most people guess the wrong one. Setting the stage. Let's make this a fair fight. Sarah and Ryan are both 28 years old. Both earn $80,000 a year. Same city, same tax bracket, identical goal. Grow real wealth inside a regular taxable brokerage account and retire with financial freedom. The only variable is strategy. Sarah builds a dividend portfolio. She allocates $1,200 a month across a blend of dividend aristocrats, companies like Johnson & Johnson, Procter & Gamble, Realty Income, plus high-yield ETFs to push her average yield toward 4.5%. Every quarter, real cash lands in her account. She reinvests automatically. It feels deliberate. It feels like she's in control. It feels like proof. Ryan does something almost laughably simple. He buys VTI, Vanguard's total stock market ETF, every single month for $1,200. No stock research, no yield tracking, no quarterly decisions. He buys the entire U.S. market and walks away. Sarah's friends love hearing about her strategy at dinner parties. She talks dividend yield, dividend growth rate, income projections. Nobody has ever wowed a room by saying, "I just buy VTI every month." It sounds passive, it sounds unambitious, it sounds like you're not really trying. But effort and outcome are very different things. The early years, Sarah looks like a genius. By the end of year one, Sarah's portfolio is paying her roughly $540 in dividends. Year two, around $1,100. Year three, approaching $1,700. By year five, her portfolio is generating close to $3,200 annually, money that arrives without her lifting a finger. Ryan, at year five, has a VTI balance of approximately $85,000. Nothing arrives, no notification, no cash event, no quarterly deposit, just a number going up. Sarah has stories. Ryan has a balance. On every visible scoreboard, Sarah appears to be winning. Here's what Sarah doesn't see. Every dividend payment she receives is taxable income in the year it's paid, even if she immediately reinvests every cent. And here's the part almost nobody explains properly. That dividend isn't new wealth appearing from thin air. When a company declares a dividend, the share price drops by that exact amount on the ex-dividend date. A $100 stock paying a $2 dividend opens at $98 the next morning. Sarah didn't gain $2. She moved $2 from one column to another and then sent a portion of it to the IRS. This isn't a controversial position. It's been established finance theory since Miller and Modigliani laid it out in 1961. The investing influencer space just hasn't found a way to make it go viral. The tax problem is bigger than you think. Qualified dividends from domestic companies held at least 60 days get taxed as long-term capital gains rates, 0%, 15%, or 20% depending on income level. That's the favorable version. Non-qualified dividends, which include most REIT distributions and many high-yield ETFs, are taxed as ordinary income, same rate as a paycheck. For someone in the 22% or 24% bracket, that's a meaningful chunk of every quarterly deposit going straight to federal taxes. Over a 30-year period, this annual tax drag costs Sarah approximately 0.6% to 1.1% in annual returns. That sounds small. It isn't. On a 30-year compounding window with contributions at Sarah's level, a 1% annual drag translates to roughly $320,000 in lost wealth by retirement. Not $30,000, not $80,000, $320,000, quietly eroded, never visible on any single quarterly statement. Ryan's index fund generates minimal taxable distributions. VTI doesn't trade frequently. It doesn't harvest gains, shuffle positions, or throw off ordinary income distributions. His annual tax drag sits somewhere between 0.04% and 0.12%. Not zero, but practically invisible by comparison. The hidden risks dividend investors ignore. High yields are often a warning sign, not a reward. AT&T was one of the most recommended dividend stocks for years before it cut its dividend by nearly 50% in 2022. General Electric, once a dividend institution, slashed its payout from over $1 per share down to a single penny. Wells Fargo cut its dividend 80% in 2020. In each case, the cut didn't come alone. It came with collapsing share prices. Investors lost income and capital simultaneously. Dividend portfolios also tend to concentrate heavily in financials, utilities, energy, and consumer staples. They systematically underweight technology, the sector that has driven the majority of U.S. market returns over the past 2 decades. Sarah essentially opted out of the fastest compounding portion of the market without realizing that's what she was doing. And there's a behavioral trap embedded in the whole structure. The dividend check feels like confirmation that the strategy is working. Sarah's portfolio could underperform the broader market by 1.5% annually for a decade, and she'd still feel like she was winning because the deposits kept arriving. The cash flow becomes a psychological smokescreen, hiding the one thing she actually needed to see. What the numbers look like at each checkpoint. By year 10, Sarah's portfolio sits at approximately $200,000. Ryan's is at roughly $230,000. The gap is $30,000 and growing, but Sarah's quarterly deposits are larger than ever, so she still feels like the smarter investor. By year 15, Sarah at $350,000, Ryan at $410,000. The gap is widened to $60,000. 3 compounding forces are running quietly in the background every single month. A return gap of roughly 1% annually. Dividend-focused portfolios have historically returned around 9%. The total market has returned closer to 10%. The tax drag, and a small but persistent expense ratio gap. Sarah's ETFs charge between 0.06 and 0.35%. Ryan's VTI charges 0.03%. None of these look dramatic individually. All 3 running simultaneously for 180 consecutive months create a gap that's impossible to make up. By year 20, Sarah at $545,000, Ryan at $680,000. The gap is now $135,000, and Sarah has paid approximately $28,000 in cumulative dividend taxes that came directly out of her compounding base. Ryan has paid almost nothing. The final scoreboard at year 30. Sarah retires at 58 with a dividend portfolio worth approximately $1,520,000. Ryan retires at 58 with a total market index fund worth approximately $1,940,000. That's a gap of $420,000. Sarah never saw it coming. Her account went up every year. Her dividend checks grew every year. Every signal she had told her the strategy was working, and technically it was, just not as well as the alternative that looked boring the entire time. Cumulative federal taxes paid during accumulation. Sarah paid roughly $52,000 across 30 years. Ryan paid approximately $4,000. That's a $48,000 swing. Money Sarah handed to the IRS annually that Ryan kept compounding in the market. Retirement, where it gets interesting. At 58, both need $55,000 a year to cover their lifestyle.
Sarah's portfolio throws off approximately $68,000 annually in dividends. She doesn't have to sell anything. It feels like she finally wins a round. But she owes taxes on all of it the year it arrives, her call or not. After federal taxes, she's likely netting $58,000 to $62,000, depending on the qualified to ordinary income mix. Ryan has to sell shares. On the surface, that looks like the weaker position, but Ryan controls when he realizes gains and how much he recognizes each year. Long-term capital gains rates in the current environment include a 0% bracket, gains up to roughly $48,350 for single filers. When Ryan sells $55,000 worth of shares, only a portion represents actual capital gain. The rest is return of his original cost basis. Managed carefully, Ryan can keep his realized gains below the 0% threshold. His federal tax bill on $55,000 in retirement income, close to nothing. Same retirement lifestyle, completely different tax outcome, and Ryan still has $420,000 more in principal, continuing to compound for as long as he lives.
When dividend investing actually makes sense. This comparison would be dishonest if it didn't acknowledge where dividend strategies genuinely fit. Inside a Roth IRA or 401k, the entire tax critique vanishes. Dividends inside a Roth are never taxed. If you want dividend exposure, that's exactly where it belongs, not in a taxable brokerage account. For retirees who value behavioral certainty, who genuinely want cash to arrive without making sell decisions every month at age 80, dividend income provides real psychological value. That's not a mathematical advantage, but behavioral advantages are real. The best investment strategy is always the one you'll actually stick with through a 40% drawdown. Dividend growth stocks specifically, companies that have raised dividends for 25+ consecutive years, have delivered competitive returns with lower volatility than the broader market. As a complement to a core index position, they're entirely defensible. The key word is complement, not replacement. What actually works? Here's the practical framework. During accumulation, build core wealth in low-cost total market index funds, VTI, VOO, or equivalent. Lower taxes, lower fees, broader diversification, and complete control over when you realize gains. Boring, effective, difficult to beat over 30 years. For dividend exposure, use tax-advantaged accounts. A Roth IRA is the natural home. The tax drag disappears and you keep whatever psychological benefit cash flow provides. Approaching retirement, within 7 to 10 years of your target date, you can reasonably shift a portion toward dividend growth stocks for income stability, as a supplement to your core index, not a swap. The actual trap isn't dividend stocks. The trap is believing that passive income is the goal when total return is the real objective. Dividends aren't free money. Every dollar of dividend income arrived with a tax bill attached and a share price that dropped by the same amount it paid. The dividend was never new wealth. It was your own capital handed back to you, taxed. For most people building wealth in a taxable account over a 20+ year horizon, the index fund wins, not marginally, substantially. The boring answer was the right one the whole time. The financial industry just never found a way to sell it at a dinner party.